If I were to give you a job description, I would say that I am a risk manager. It is my job to identify the different types of risk to my clients, quantify how much of each risk they are exposed to, and then come up with a plan to mitigate or eliminate those risks. Now it's left a haze on here. I'm not even sure if you guys can see this haze or not, but I'm just going to give it another wipe. All right. And so looking at everything from a perspective of risk first, if you're wanting to control risk, rather than using this 5-bucket approach of moderate, moderately conservative, and so on, there's a simpler method, and it works very well. And it's to think about anything you own, it doesn't matter what it is, and it will fit into one of these buckets. So if you look at something you own and you say, can this lose money? It can. Okay, then it goes into the at-risk bucket. And in our software, we color it red. That's not working. You'll just have to read the word. We call it red money for ease of understanding. And then if you look at something else you own and you say, can this lose? No, it can't lose. It's guaranteed not to lose, or it's extremely unlikely to lose. It goes into the green bucket. Okay? And then we have also incredibly important emergency funds. Now, hopefully you can see, we color this blue, by the way. Hopefully you can see how this is more effective because it allows you to control risk on a guaranteed basis rather than an I hope so basis. As an example, let's say that you consider yourself a moderately conservative investor based on the traditional methodology. Well, if you look at your estate or your liquid net worth as a pie, right? Well, we want to have somewhere around 3 to 5% in blue money. And this is for a typical, $500 to $1 million liquid net worth, $500,000 to $1 million, because these percentages change depending on the size of your estate. And then you might have, let's just say 40, my drawing is so good, isn't it? I'm just gonna color it in. All right, and you might have, let's say 45% in green money that isn't going to lose. And then of course, what do we have left? We've got 55%, assuming that's 5%, in red money. Now, what you have here is a situation where you have reduced your possibility of loss, assuming that you would normally just keep the emergency funds. Those are always going to be there. But you've reduced your possibility of loss by 45%. And if you remember when I was talking to you earlier about negative compounding and the power of it, I'm going to pull this slide back up right here and show this to you. A lot of it's very interesting because the truth is that that's not working. I'll just keep myself off of it for now. But you can see that it's actually an exponentially moving target. What you've got here is the losses on the left side, 5%, 10, 15, 20, 30, 40, 50. And what it actually takes in terms of a percentage performance, just to break even, just to get your money back, right? So if you're down 15%, it takes 17.6% just to get your money back. If you're down 40%, it takes a 67% return to get your money back. I know this can sometimes be a little confusing, but usually everyone kind of gets the last one. And that's if you get $100,000, you lose 50% of it, you're down to $50,000. What percentage of 50,000 do you need to get back? Well, you need the whole thing, right? Now it gets really ugly when you get past 50%, but it's an exponentially moving target. So if you can imagine taking some of your money and putting it in a situation where it cannot lose, it actually increases your probability of success. However, when it comes to risk, there's really kind of two thoughts. There's risk tolerance, which is what everyone's familiar with. That's what I refer to as risk willingness, how much risk you feel like you should be taking. Unfortunately, most of the industry just bases everything they do off of just your feelings about risk. But the truth is there's also risk capacity, which is how much risk you should be taking or could be taking. And the only way to actually really determine that accurately is to do a financial plan, a cash flow analysis, which shows you what every month of every year looks like going forward, or some projection that you can conservatively project the future and see exactly how your cash flow goes. If there's a red line, if you run out of money at some point, well, that's going to create a situation where you have less risk capacity, right? Forgive me. So, of course, a lot of people will ask me, like, how do you do that? How do you separate your assets into those boxes?
Click the card in the corner of the window to continue this webinar. Please remember to like this video and subscribe for more educational content.